So when it comes to investing, one of the main challenges that people have is juggling this whole concept of risk. They consider things at times to be a lot riskier than what they are, and at other times they don't realize how risky something is. And the whole concept of risk is something that I've been watching very, very closely, that I've been following over the past 12 years or so, working with a lot of investors. And it's something that was recently addressed in Tony Robbins' book. Tony Robbins is a very well-known author, motivational speaker, and he went out there a year or so ago and wrote a book about money concepts. He went and interviewed some of the brightest investors right around the world, and he asked them how to make money. What's trying to demystify the whole investment concept. And one of the things that came out from those discussions was how the smartest investors always looked at risk relative to reward. So the risk to reward ratio is really how they conceptualize or how they manage their risk. It's what they use in order to qualify risk, to find out if something's risky, and then decide whether that risk is good enough or something that they should take. So the first point that I want to make is that risk is always a relative process. You should always look at risk relative to return when you're going out and investing. So risk to reward ratio, you take a unit of risk and a unit of reward, and you want a risk to reward ratio below 1. A risk to reward ratio below 1 means you're taking less risk for every unit of upside. Let me give you an example. Let's say you want to go out there and purchase an investment that's at $1,000. And you do all your calculations and you put down some assumptions that the most you probably will lose is about $200. So that's your risk. $200 is your risk. But you think if things go really well during the same period of time, I can probably generate a return of 50%. So you would make $500. So your risk to reward ratio will be 200 over 500. That'll be 0.4. So that's an example of a risk to reward ratio that's attractive. The smaller the number is, the more attractive the investment becomes. The higher it is, the more unattractive it becomes. And so this is how investors conceptualize their risk to reward. The second point that I want to make is that risk is too prone. There's price risk. So in the prior example, we spoke about the $200, something going from 1,000 to 800. But there's also business risk. There's also asset risk. So you have to not only take the movement in price, but all the other things that could go wrong. If you're out there buying real estate, for example, it's not just the movement in price of your asset, but it's also the risk around your tenants, around your financing, around the quality of your building, for example. If you're out there buying stocks or if you're out there buying businesses, it's the risk of your CEO, something happening to your CEO that will affect price risk. So it's not just the movement in price. It's about writing down all the risks that you can think about, but then equally dividing them by all the opportunity, all the upside, all the potential upside. And obviously, if you have more time, that ratio becomes a lot more attractive. So the key takeout here, guys, is that your risk to reward ratio is really the center point of your risk management. It's a way to not lose money. It's the way to become a better investor. These types of concepts I talk to my clients, to those who are on our list, on a weekly basis. We show them that, and we also show them other practical ways to become better investors. The link to get onto our list is in our show notes. We don't charge anything. It's all free, and we'd love if you could join us so that you can also start to think about your risk relative to your rewards and become a better investor. Thanks for your time.